So the earnings season is wrapping up. Today I'm going to do a review on 3 companies. The first one is ILMN. Let's look at the quarterly revenue that's shown in the graph on the bottom right. So we can see that the second quarter revenue was actually a rebound from the recent declining trend that started about 1 year ago. And also, the gross margin rebounded in the second quarter. That's also a reverse of the trend that started about 2 years ago. However, the management gave a downbeat about the whole 2023. The guided sales will be up only 1%, a revised down from 8.5% increase guided previously. That's due to fewer COVID tests and the transition from the NovaSeq 6000 to the X. Keeping in mind the NovaSeq 6000 was launched in 2017. So if we look at the graph in the top right, we could see that the 2017 revenue was also a significant dip from 2016 with a reduction in gross margin. The management also blamed the negative impact from China as well as negative macroeconomic impact around the world on the revised guidance. So the Wall Street didn't really like that change and took ILMN price down significantly. However, as a patient investor, what I care more is about 2024 and beyond. So can ILMN return to growth as shown in the general trend in the top right graph? The key is it's a new equipment, the NovaSeq X. On that front, the management actually revised the guidance up. So for the whole year 2023, management is now expecting more than 260 equipment orders comparing to initial guidance of 140. And the shipment for the full year will be 390 or more compared to initial estimate of 300. So NovaSeq X actually is being adopted faster than expected. The side effect is the users will be reducing the consumables related to NovaSeq 6000, and because of the consumables have higher margin, then although it's selling more NovaSeq X, but that's with a lower margin, then overall the margin is a reduction as well as a reduction in the sales of a consumable in this year. So I see that as a temporary problem. Now let's look at the valuations. So the EV over gross income now is about 10, lowest since 2017. That's based on the share price of $168. Keep in mind the grill has no gross income. So the upside from grill is not reflected in the EV over gross income metric. So my initial investment thesis is to buy a growth company with a good valuation and getting grill for free. I think that still stands. However, as I mentioned before, my own conviction is low because there are a number of threats related to grill and my lack of understanding of competitive threats from other genome sequencing companies. Therefore, I need to build my investment size accordingly. So far, I haven't bought any ILMN stock. However, with the recent pullback in the stock price, I can see myself making a purchase in the next couple of months. The next one is ingredient. So let's look at the table. Under the second quarter, its revenue was over $2 billion. That's a increase about 1% from 1 year ago. The good news is a gross margin. came in at 21.3%. That's up 220 bips from 1 year ago. And the specialty mix was 34%, same as 2022. Because of the margin improvement, adjusted ops income was $251 million, up 17% from 1 year ago. And the working capital had a negative impact on cash flow for about $218 million. Despite of that, CFFO was $279 million. That's a turnaround from a negative cash flow of $51 million in the first quarter. So overall, I would think the quarter was pretty strong for ingredient. However, there is one issue as related to the volume in the second quarter. So in the second quarter, the pricing was up 15% year on year, but the sales was only up 1%. That's because the volume was down 11%. The management blame on reducing of inventory of its buyers, as well as impact from just reducing of supply chain logjam. So the management believes the volume reduction was a temporary issue. So at $99 per share, its PE is about 11. I think that's attractively priced. However, if the volume keeps going down in the third quarter, then that will be more than a temporary issue. Then the whole investment thesis has to be revisited. Finally, I'm going to present a chart related to NVDA. I don't have NVDA in my stock portfolio, and I don't plan to build any position in NVIDIA. So why do I care about NVIDIA? That's because NVIDIA had a huge rise in stock price in this year. Now the market cap is around $1 trillion, become one of the largest company in S&P 500 right now. So we need to understand NVIDIA's valuation level to get a handle on the state of the stock market. So this chart presents multiple information together. Let's look at the vertical bars first. That's NVIDIA's annual revenue since about 20 years ago. We can see that its revenue was on a steady but somewhat slow increase. However, since 2016, NVIDIA's revenue started to take off. Then there was a huge jump from 2020 to 2021, then stayed somewhat flat in 2022, and a slow decline in the trailing 12 months compared to 2022. Very importantly, NVIDIA's gross margin, as shown as the purple line, improved significantly from 20 years ago. In 2003, its gross margin was about 30%, then just a steady climb up and reached about 65% in 2021. There was a dip in 2008 and 2009 and 2010. That's because of the global financial crisis. Otherwise, the rise in gross margin was fairly steady from 1 year to the next in a continuous upward trend. That coupled with the rise in its revenue shows that NVIDIA has been making products that have been in demand and also building its moat slowly so that it can charge a premium reflected in its gross margin. Next, let's look at the return on invested capital before tax. So before 2016, except the jump in 2006, 2007 and the dip during the financial crisis, its return on invested capital was usually around 20%. However, that changed since 2016. Its return on invested capital reached a peak around 50% since 2017, except a dip in 2019. Then a reduction in 2022 that coincides with a fast revenue increase in 2016. So, what was the reason for the much faster revenue growth and higher return on invested capital since 2016? My answer is artificial intelligence. I remember I was reading a paper about artificial intelligence in 2016. That's when AlphaGo beat the top human player in the world. I think that is a similar event as the recent chat GPT and the demonstration of its capabilities. So in 2016 and more recent years, AI has been used in many areas, including machine vision and also different pattern recognitions, including recommendations for music or video pieces for people to watch. So AI is not a recent phenomenon, despite ChatGPT really opened a lot of people's eyes. So what will ChatGPT and other large language model do to NVIDIA's business? I'm pretty confident to say that its gross margin will rebound and be trending up again. However, there are competitions including Intel, AMD, and Google as well as Amazon. All of them are making GPU specialized for artificial intelligence. So for a hardware maker, there is a limit on how high the gross margin can be. Just for reference, even for software companies, the gross margin usually will not be much higher than 80%. I also believe the return on invested capital will also rebound, probably reach over or hovering around 50% for NVIDIA. So the key point is NVIDIA's business will be good and its profitability will be good too. But what about its valuation level? So let's look at the red line, that is the ratio of enterprise value over gross profit. By using gross profit instead of revenue, I take into account the improved gross margin. So we can see that the EV over gross profit, the ratio used to be less than 10. Then it jumped up after 2016. I would say coinciding with the exploding revenue growth as well as improved return on invested capital. So in the recent years before this year, the ratio was a little over 30. However, this year with the ChatGPT and the AI hype, it recently reached over 70. As I mentioned earlier, I believe NVIDIA's return on invested capital will recover to over 50%, but not much higher. And its gross margin will trending up, but will be limited by how high it can go. So with all that information and also with a second wave in AI in terms of large language model versus previous pattern recognition in imaging, I would say its revenue will have a similar growth trend, which can probably justify EV over gross profit around the 30 or even 40 times, but not 70. Therefore, I believe NVIDIA is severely overpriced at this point. I'm going to stick my neck out to say 1 year from today, at the end of the summer next year, its enterprise value over gross profit will drop below 40. So part of it will be driven by a jump in gross profit, but part of it will also be a reduction in its stock price. So I'm confident to say that NVIDIA's easy money has been made for anyone buying at the current stock price. I would say the best case scenario is just a fairly stagnant stock price in the next 12 months. This concludes this episode of Quest for Twice. Until next time, happy investing.